The US economy has entered a danger zone. In 2008, the United States took a very serious decision that it's going to run the largest deficit in history. That should have ended the dollar as the global reserve currency, but it did not. So it angered many other large nations such as India, Russia, and China, because from now onwards, the United States could print its way out every single crisis, while these nations had to work hard, build real stuff in order to grow their economies. But the United States, on the other side, could continue growing its economy by just borrowing as much money as it possibly can. So in 2009, these countries came together and created an alliance called BRICS in order to put an end to the dollar as the global reserve currency. And since then, there has been a lot of rumors that they will come up with a currency that will replace the dollar as the global reserve currency. However, 16 years later, not only that these countries could not even build a common currency, but they're far away to ever replacing the dollar as the global reserve currency. So how is it possible that the United States has the largest debt in history, that the United States is running a $2 trillion deficit, and yet nobody can even challenge the United States? And these huge nations that are economically bigger than the United States, that have far more people, that control far more resources, cannot even build a currency that could challenge the US dollar. Now, to understand that, we have to understand how currencies work in the first place. A currency like a dollar or a euro or a pound is an artificial commodity created by the government to control the economy, primarily to control prices on one side and to grow the economy on the other side. So if prices are rising so fast, and because when people buy things they use the local currency and the government has a monopoly on that currency, the government can simply limit the inflow of that currency, which is going to slow down the demand, which is going to slow down inflation, and prices won't get out of control. If the government would have used the gold as a currency, then the government would not have that power because the government do not has all the gold in the world. On the other side, it's about economic growth. When the economy slows down, because the government can artificially create that currency, it can pump money into the economy, which is going to drive demand in the economy, which is going to grow the economy. Because the economy runs in multiple cycles, so there is a period of prosperity when the economy is rising dramatically. But at that stage, things could get out of control and prices could rise way faster than anybody else wants them. So in order to prevent the economy from turning into one giant bubble, like it happened in 2008, like it happened in late 1990s, or like it happened in multiple other occasions in American history or the history in the world, in fact. The government can limit the supply of money, which is going to slow down the demand, which is going to prevent the bubble from forming or from getting even bigger. At a certain point, the economy slows down and it turns into a financial crisis or a market crash, and that crash could last a few months, or sometime it could even last a few years, or even 10 years like in the case of Great Depression. We call it a recession if it's 2 consecutive negative GDP quarter, or a depression when it lasts more than 2 years. In this case, the government has a tool to control the economy. The economy is suffering, nobody is buying, nobody is investing. But the government has the magic trick. It can literally print money, create artificial demand, push people to start investing, people start buying, people start investing. For example, the government can start borrowing money because the currency is artificially created, take that money, start a few more projects, hire people. Those people will receive paychecks from the government. They will take the paychecks, they will go and buy a car, treat themselves in restaurants, buy houses. That money is going to circulate within the entire economy, and the economy slowly gets out of that financial crisis. And that's why it's extremely important to have a currency and not have gold as a money in the economy. And all of that is done by the central bank of that country. In the US, it's the Federal Reserve that has the power or the authority to create the dollars. In England, it's the Bank of England. In China, it's the Bank of China. In Japan, it's the Bank of Japan. The first tool at their disposal is the interest rates. By raising the interest rates, borrowing money becomes more expensive. So if you wanted to open that coffee shop or start that business, if interest rates are 10%, you're going to think twice before borrowing money to start coffee shop, because now you have to pay a lot more. If your coffee shop is not making enough profit, you won't be able to cover the interest on that debt. You're not going to borrow money, you're not going to spend, and inflation is not going to rise. On the other side, if interest rates are dropped to 1%, suddenly if your coffee shop is making 7% ROI and you can borrow money at 1%, it makes sense to borrow that money and open your coffee shop and start doing business, and that will stimulate economic growth. Another tool is, of course, quantitative easing or quantitative tightening. Now, quantitative tightening is basically opposite of quantitative easing. When the central bank directly buys a lot of government bonds, that gives the government a lot of money, and that a lot of money will be spent on the economy, which is going to drive economic growth. And that's how basically currencies work. Now, it's very difficult to have one currency for two different nations. Let's take an example of the European Union. So we have Germany on one side and we have Greece on the other side. And both of these nations use the euro. Now, the problem is that these two economies could be at entirely two different economic stages. One could be growing dramatically, while the other could be in a financial crisis. So the right policy for Germany might be to hike the interest rates to prevent it to turn into a bubble, while for Greece it might be to lower interest rates or devalue the currency so that the country gets out of the financial crisis. But you cannot possibly do that because you have one currency. And if you have one currency, then both of these countries have one central bank. And that central bank cannot possibly have one interest rate for one country and a completely different interest rate for another country. And that's why because that is impossible, and if you ever have that, why have that if you can simply have two entirely different currencies? So in order for two or more countries to have one currency, like in the case of the European Union, you need these economies to be deeply integrated. So they have to function as one giant country. So in the US, you have 50 states, and all 50 states use a single currency because they act as one giant country, because there are one giant country. But in the European Union, they're trying or have been trying to integrate their economy so much that they won't be competing against one another, but rather they will be complementing one another. Germany is a manufacturing powerhouse. They're producing Mercedes, they're producing BMWs, they're producing a lot of really sophisticated technology. But France is major in agriculture and luxury products. Louis Vuitton or Dior or other famous luxury brands are all coming from France and not Germany. And then you have Spain that attracts the rest of the world with its tourism. Spain is not building really fancy cars, but it's mostly the place where you come to have a very beautiful, nice vacation. And then in the southern part of Europe, you have Netherlands that specializes in logistics. It also specializes in a lot of other technologies, but it has one of the largest ports in the entire European Union and literally specializes in logistics. So European economies are very deeply integrated. So when one of them gets into a crisis, such as the Greece debt crisis, the rest of the union cannot possibly function because that country is in a crisis and it drags the rest of the countries within itself. The logical thing, for example, when Greece went into a debt crisis would be for Greece to devalue its currency so it will be easier for Greece to pay off its debts. Yes, investors are going to suffer, but investors will view Greece as a very risky investment. But because Greece borrows money in euro, it also puts in danger the rest of the countries that borrow money in euro. And the reason that the rest of the countries are borrowing money in euro is because euro is a single currency for all of these nations, and that's why growing European economies is so extremely difficult. Now, the euro is not a very old currency. It came out literally like 25 years ago, and 8 years later, it actually encountered the biggest challenge in its history. And since then, European economies are not growing much, while the US economy is growing tremendously. In fact, the rest of the world is growing tremendously, and the EU economies are actually stuck because Germany had to provide hundreds of billions of dollars to save Greece, because if Greece won't be saved, then its currency is going to plummet, and if euro is going to plummet, it is going to come and hunt Germany again. But if you successfully build a stable currency for your country or multiple countries in this case, the next question is, how do you turn your currency into a global reserve currency like the dollar? So here is a step-by-step process to do that. Imagine you are a government that already created a very stable economy that keeps growing and you have a very stable currency. You create a bond market. The bond market is the place where the government is going to borrow money from investors. You are giving an opportunity to investors to make money by lending that money to you. And why are you, the US government, want to borrow so much money? Because you have built the perfect economy. You take that money and you invest that money into the economy. The economy keeps growing, people pay more taxes, and you pay interest to the bondholders. So investors from all across the globe starts to love your bond market. They're like, what are we going to do with our money? We can simply buy US government bonds because the US government bonds provide us with a very stable returns, and this is the safest investments possible. Look at the US economy. The United States has created the perfect economic model that keeps growing. But because when the economy is growing and the economy consists of different companies, these companies keep growing and they start trading themselves or their shares in the stock market. So the stock market begins to grow us again. So investors who made a lot of money from the bond market, they're like, we're going to take this money and also invest it in the stock market. Because what else are you going to do with money? When you're making dozens of millions of dollars at least, or hundreds of millions of dollars, or like in some cases, billions of dollars, there is nothing to do with that money. That money should be invested somewhere and it should keep generating interest. It should keep growing in the stock market. It should keep being invested somewhere. So that money keeps growing and growing and growing. Otherwise, if that money is sitting in the bank, inflation is eating it away and you're losing money on consistent basis. But to invest in the US bond market, you need dollars. So the demand for dollars begins to rise. And now you have two different countries that are not related to the United States. Let's call them country A and country B. These two countries want to trade with one another. And they're looking, which currency should we use? Should we use the currency of the country A, or should we use the currency of country B? Now, these two nations cannot trust each other because none of these economies are big enough. Maybe they have small population, maybe they don't have a very good track record. Even if they trust each other and they start trading in their own currencies, imagine country A received the currency of country B. What are they going to do with this currency that is sitting in the central bank of the country A? Nothing. It is being eaten away by inflation every single day. So country A and country B will say, listen, let's trade in US dollars because if I have extra dollars, I can simply invest it in the US stock market. And if I have extra US dollars, I can also invest it in the US stock market. So they're not sitting simply in our central banks, but generating interest for us. So whenever we need them to trade among one another, we are simply going to sell a portion of our bonds. And why do we trust the US bond market? First of all, it's very liquid. Even if I have $100,000 of US government bonds, I can literally sell them the next day and I will have $100 billion of cash in my bank account and I can instantly do business with the rest of the countries. Can I do something like that in any other country? Of course not. It's also big enough. It consists of it's valued at around $37 or $50 trillion, and it's very stable. Everybody there and everybody trusts the system and everybody can keep making money out of it. So because we have this perfect economic model that continues to grow, that continues generating interest, the rest of the countries don't actually care whether they like the United States or hate the United States. By keeping the dollars, you can keep them invested in the bond market that will generate interest, and whenever you need that money for international trade, you can sell your bonds and start doing international trade with the rest of the countries. And that's why the rest of the world uses the dollar as the global reserve currency. So if you want to replace the dollar or challenge the dollar, you have to create the exact same system. And that's why even though that European economies is almost as big as the US economy, they cannot compete with the United States. They cannot replace the dollar as the global reserve currency. Even though that EU is deeply integrated, they literally act as independent countries. So Greece has its own bond market, Germany has its own bond market, and France has its own bond market, and the same applies to every single European country, even though that all of them are using the exact same currency. But if one of these countries are going to be in a crisis, if one of these countries won't be able to pay off back to investors will be worried. And they're like, maybe Greece is going to default on its loans. But if Greece is going to default on its loans, it is going to default in its currency. Well, if Greece defaults in its currency, other EU countries are using the exact same currency, and we have one central bank for all of these currencies, which puts at risk every other European countries. And that's why if the EU ever wants to replace the dollar as the global reserve currency, they need to be so deeply integrated, and they need to create one giant bond market for the rest for all other EU countries. But we're far away from that, because every EU country acts as if it's an independent state, even though that they are very deeply integrated. And now you have to ask yourself a question. What is the problem with BRICS countries? BRICS countries, especially India and Russia and China, all of these countries are extremely big. Both geographically, these are huge countries. In fact, Russia is the largest. India and China are some of the largest. And these two countries have so many people. Like in the case of Germany and Greece, it is very different. Because if something happens, Germany can bail out Greece. Greece is a tiny little country in the southern part of European Union. And it's not actually that rich. It has a GDP of $200 billion. While Germany has a GDP of almost like $5 trillion. It's one of the largest economies in the world. So yeah, if there is a crisis, maybe the big brother can bail them out. But how about India and China? These are two huge countries that have a population of 1.5 billion people, each of them. And if something is going to happen to one of them, they cannot possibly rescue one another. Not only that they cannot compete with the United States, but also they can't possibly create one currency for all these countries, because these countries are at different economic stages. Inflation in China is extremely low, so China has to keep low interest rates and to continue growing its economies. While inflation in Russia is extremely high, so Russia has to increase its interest rates in order to tackle inflation. Now, which policy is going to work for both of these nations? China is competing with the US on GDP. So they cannot raise their interest rates to 20% like Russia because they need to keep growing their economies. It doesn't work with them. On the other side, India is trying to become a manufacturing powerhouse and compete with China to manufacture the same things that China is manufacturing today. But to do that, they need to have a much weaker currency than China. So if these three countries come together and they will create one giant currency for all of these countries, suddenly managing the economies of these three countries will become literally impossible. And I did not even talk about one common bond market, where all of these countries will borrow money in the exact same currency in order to provide that attractive thing for investors, where investors can look into that and keep buying the bonds of this new currency, and they will keep generating interest. Because if you can't have one single currency amongst all of you, you can even forget about creating a common bond market for all these countries. Even European countries that are so integrated, that are so close with one another and have way smaller population and smaller countries are not even close to creating one giant bond market, leave alone for these countries to do that. So, will BRICS countries ever challenge the US dollar? You see, the United States is actually taking a huge risk by running such a huge deficit, and it puts the United States at such a risk. But the problem is that there is no alternative to the US dollar. Literally, European Union can't step in because they don't have the exact same tools. China and BRICS countries cannot possibly create one giant currency because it simply won't work with them. The only reasonable solution is for China over time to become the world's largest economy and create a bond market that will rival the United States. But to create a bond market that will compete with the US, you have to be fully transparent so that investors will feel confident buying your bonds. But China does not have the exact same democratic system that the United States has. Now, you can criticize the US as much as you want, but the United States has a very fair democratic system that might not be 100% fair, but it's far more transparent than the Chinese system, which is why if you're an investor with a lot of money, you're more likely going to trust the United States and China, even if you might not like the United States with full of your heart. And that's why BRICS countries are so far away from creating a currency that will ever challenge the United States, which means that you can be confident about the US market, even though that the United States now is taking a very serious risk. And that's why if you're not in the stock market yet and you're not making money, the rest of the world is making money out of the United States. So make sure that you join the rest of the world and you become an investor and you start buying assets and you start buying stocks that will make you ultra rich. And if you want to know what are the best stocks to buy right now, then check out the first link in the description of this video. Thanks for watching, and I will see you in the next one.